What's going on with the housing market? What's going on with the rental market? We're seeing prices continue to increase, but are they going to stop increasing anytime soon? Well, a recent report by Zillow goes over some of those numbers, so let's get into that. So here's that article from Zillow. It's a report going over June prices in the housing market and the rental market to see what rent prices and what home prices are actually doing. The data lags a little bit, so it's last month's data, and we'll get July numbers next month. They put out a report every single month. And we can look first at what's going on with housing prices, since that is so directly linked to eventual rent prices. Since as housing prices rise, you'd expect rents to rise with it, even if there's a little bit of lag before that actually happens, since they're very intertwined. If a landlord has to pay more for a property, they're probably going to charge more rent to then pay for the expenses on that property. And keep in mind that all this data is aggregate data, so it's looking at the entire country. You could cherry pick different submarkets that have much more exaggerated results, since there might be more demand for a particular area or much less demand for a particular area. And that's even in an otherwise hot market. You could see prices fall in certain areas, but overall, this is looking at the broader picture in the United States, and it is telling for most markets. And as Zillow summarizes, intense demand for houses over the course of the pandemic sent inventory plummeting, bottoming out in April down 33% from the year prior, serving to ramp up competition for homes and elevating prices. But inventory has begun to recover since then, up more than 3% month to month in both May and April. In June, inventory was down 29.2% from last June 2020. I'm going to push back a little bit here in that it was intense demand for houses over the course of the pandemic that sent inventory plummeting. Yes, there was increased demand mainly from lowered interest rates, so people had more purchasing power with the same amount of dollars as before. You could get more loan with the same amount of money, and that goes for basically everyone. So you basically had it where everyone could afford more home at the same time, but it wasn't just all demand. We had plenty of supply issues as well, and many of them still continue. Not only do you have the actual material cost bottlenecks that we've seen in lumber and other goods, but also with existing supply, we have the foreclosure moratoriums, we have eviction moratoriums, things that really put a pause on the actual market and stopped new supply from coming online, both on the rental side and on the sales side. And as I've covered on this channel before, when it came to 2020, the housing market had about the same number of transactions as it had in 2019. The big difference was there was way less supply online. So you had about the same number of buyers, or at least same number of transactions, but way less inventory to choose from. So naturally, when you had less supply, but nearly the same amount of demand, perhaps more because of interest rate fluctuations, you thus had this massive increase in real estate prices. And that's really continued into 2021 with many of these supply issues still going on, but also demand seems to be picking up even more than it was back in 2020. Though we did see some increases in the last couple months after hitting the bottom in April of 2021. So we'll see if that trend continues. And next to it, they have the year-over-year graph, and you really got to be careful with any sort of year-over-year graph, since if you have 2 months that happen to be anomalies, but they line up a year apart from each other, it'll make it look like something wild happened between those 2 months, when really it might just have been 2 off months that make it look like the actual year that we had was a lot stranger than it might have actually been. I'm not saying that 2020 wasn't actually extreme for real estate, and same with 2021 thus far, but year-over-year graphs aren't particularly helpful when you're trying to look at a long-term trend. Anyways, what about prices? Well, we can see on Zillow's home value index that prices have continued to soar, and that's partly because of the interest rate decreases that I mentioned already, but also because of newly increased demand, and also because it's harder for homeowners to actually build new housing, at least as affordably as before, because supplies are also increasing in price. But we have seen lumber tick down from its recent highs, but still it's much higher than it was a year and a half ago. But as you can see, based on Zillow's index, the prices we're at now are well above what we had back in 2006, 2007 during the housing bubble at that time. Granted, we're in a much different environment now, and that way more money has actually been printed, so the value of dollars now is probably much, much less than it was back in 2006, but still, it's cause for concern given what's happened in such a short period of time. Because the actual value that housing provides, the intrinsic value of housing, doesn't change all that much. Sure, you could have different factors like added supply or reduced supply that could dramatically change it one way or another, but really, that's not going to happen very often. The actual intrinsic value in providing shelter, which housing does, that doesn't really change very much. What does change is the kind of money that can be used to get the housing. I'm really talking about debt here. So when you influence the interest rate, make that lower or higher, naturally the amount of dollars that people can use to spend towards housing goes up or down based on the interest rate move. And that's not really changing the value of the housing. All it's really doing is artificially changing the cost of money to buy that housing. But the actual value of that housing doesn't change very much, and this makes sense given that what really happens when interest rates go down is that the monthly monthly payment that you might have had before simply gets transferred to a lower interest rate loan, and thus people are going to pay more because their actual payment is the same, even though they're paying more for the house, because the cost of the money is cheaper, so they can afford more house with the same actual payment as before. And the exact opposite would happen if interest rates were to go up, which can happen. But anyways, what about rent? Since the rental market is closely tied to the actual housing market, and we've seen distortions in both because of some of those government programs I mentioned. We got the eviction moratoriums, we have the foreclosure moratoriums. That has definitely skewed both of these markets in different ways, and that's before we even get into monetary policy, all the stimulus programs, and the programs that have flooded many markets with lots of new dollars. But as Zillow puts it, rent growth maintained widespread momentum in June, with the Zillow Observed Rent Index up 1.8% month over month, pushing typical U.S. rents to about $1,800 a month in June. And remember, this number may change quite significantly with each market. This is looking at the broader U.S., so the number is not particularly important. We're really looking at the growth rate to see how much are rents growing across the board in the US. But anyways, a strong recovery in the rental market over the past few months pushed year-over-year rent growth up to 7.1%. Again, that's because we had a very strange time period from March to, say, July of 2020, where the rental market and the real estate market were very much in suspension. We were waiting on different stimulus programs and all sorts of things that were going to roll out, waiting for those things to end. There's a lot more uncertainty with the pandemic, so when you're comparing month to month, year-over-year stuff, you got to be very careful. Looking at the longer term trend is pretty important. But Zillow does point out that even discounting a weakened market last year, rents have risen 5.1% since March of 2021. That is the fastest quarterly growth in Zillow's data. That is a very significant increase in a pretty short period of time. The fastest monthly rent growth was seen in Las Vegas, 3.6%, Tampa, 3.4%, Austin, 3.4%, and Phoenix, 3.3%. Sunny, relatively affordable areas have led home value appreciation over the past year and are now seeing outstanding rent growth as well. Because again, this is rent growth, not price growth, and prices there are certainly soaring as well. But we can see on the Zillow Observed Rent Index that rents have continued to rise. Really, I would say that rents are probably a better proxy for inflation than many other things. Granted, the CPI vastly discounts housing and doesn't really look at many of the things with it, thanks to interest rate fluctuations and all that sort of stuff. But rents really don't go down even during harsh times, because expenses don't really go down either, and rent typically is more correlated with the expenses on a property than anything else. Of course, demand factors can push those things up, but typically with the rental market, as one market appreciates, you'll probably see another one depreciate as people move from that one market into the other. So if you look at aggregate US data, where it kind of takes some of that in, and that when people move, it's going to negatively impact one market, but positively impact another most likely, it probably kind of negates that sort of concern. And housing is an expense that everyone needs to pay. And like I said, the value of housing, the intrinsic value, doesn't really change. It's providing you shelter, and you can make it nicer with certain amenities and things like that. But typically you're going to have a pretty broad range of very bare bones apartments, bare bones units, and then very luxury-esque large complexes and units or whatever for the ultra rich. So you're going to get a pretty broad range there, with something in the middle being where most people fall. But if we look at this graph, 2020 saw pretty sideways rent growth, or really no growth. It was very stagnant. You didn't see a whole lot happening. We had the eviction moratoriums obviously distorting the market. More people are going back to work, so their incomes would theoretically increase as well. Lots of things are happening that could be pushing this number up. Plus, eviction moratoriums in many states are ending, and also the federal one appears to be about to end very soon. It'll be interesting to see what happens when all of the eviction moratorium programs throughout the country end, or at least are tapered off. There's no guarantee that they will end at all, but it'll be interesting to see what happens, because I would expect more supply to come online for the rental market, which could push prices down. But you can also see the opposite happening, where in lieu of an eviction moratorium, you might see more rental assistance programs that boost the income of renters and thus boost the demand of the market artificially, and thus allow landlords to charge higher rents because they have more demand coming for their units. I suppose what I'm really getting at here is that the government, both the federal and the state governments, will play a pretty big role in what happens with both the rental market and the housing markets. We've had so much money come in from government programs to help prop up the housing market and also help prop up the rental market by freezing evictions, but then also flooding it with more money through rental assistance programs. How much of this will continue will be a big factor in what actually happens to both the housing and the rental markets. But if you guys want to check out the Zillow report, I'll include a link to it in the description below. below. They put out lots of good data on the residential housing market and the rental market, so definitely check that out if you get the chance. But otherwise, that's all I've got for today. So if you like this video, please like it, since that would help the channel out a lot. And if you like this sort of content about real estate, investing, the markets, and pretty much everything as it has to do with personal finance, then be sure to subscribe, since I put out new videos every single week and wouldn't want you guys to miss out. And check out some of the free stuff in the affiliate links in the description below. But until next time, take care.